Medical Properties Trust is a real estate investment trust that's seen its stock price collapse in 2023. As you can see here by looking at stock price only on Google Finance, it's fallen from over $22 a share all the way down to below $8 a share. Problem is, many investors only look at stocks in the context of what we see here, with stock prices only. Problem is, stock prices can be pathological liars. The market will often misappraise a stock, and the only way that investors can know whether that's happening or not is if they have other information so they can get a perspective of whether the stock price is reasonably priced, overpriced, or underpriced. Hello, everybody. This is Chuck Carnevale, co-founder of FastGraphs, the Fundamentals Analyzer software tool, also known as Mr. Valuation. And we recently did a couple months ago, we did an article on Medical Properties Trust. And this has been a stock that I've been asked almost every time I've published a video since, what do I still think of Medical Properties Trust? Do I like the stock? What's changed? What's happened? And of course, what everybody's doing there is reacting to stock prices. And the problem is stock prices can really be bizarre. They can really lead you astray if you don't have other facts to look at. So what we're going to do here in this video is we're going to look at Medical Properties Trust from a fundamental point of view rather than stock prices. As I showed in the original frame here, that when you look at a lot of sites like Google Finance, all you see is stock price, and you see the stock price going up or the stock price going down, and that's all you have to go on. So we're going to look at it more from a fundamental perspective in this video and talk about what the probabilities and possibilities are. And later in the video, I'm going to invite my son Colton to come in and go through the financial statements with you and just talk about the things that we see in the financial statements, whether or not we see any real danger signs or not. We're not going to provide opinions. We're just going to provide the facts, if you will. So let's go ahead and get into the video here. And I'm going to once again go back to the Google Finance chart here. And all you're looking at is stock prices going back here to 2005. And you can see the stock prices rise and fall several times. And then you see that big collapse I talked about. But when you look at a fast graph, difference would be when you look at a fast graph, you get a different perspective. So we're going to go and look at funds from operations, which is the metric that you really utilize to look at REITs. We're also going to take a look at adjusted funds from operations. Now, when I'm personally analyzing REITs, I like to look at funds from operations because it's more of a GAAP-oriented number. It's a standardized number. The AFFO number is not a GAAP number. There's some discretion that companies can have when they report AFFO, but this becomes important. I'll talk about later in the presentation. Now, as I do this, as I go through these numbers, what I want to point out here is that I've got this stock price that you can see, being volatile all over the place. And I want to start with some common sense here. Obviously, the market is not always pricing the stock correctly if you're just looking at the stock price. It's very, very volatile and very, very erratic. But if I take price off of the graph, and I'm going to shorten the time frame a little bit here and just look at post-2008 recession, the company's funds from operations, which is a form of cash flow, if you will, for REITs. And REITs, have to distribute 90% of their distributable cash to their shareholders or their unit holders. That's one of the real advantages of investing in REITs, is that they're a great income vehicle. You can see this company has done pretty well. It's had some periods where, funds from operations have fallen a little bit, and you see periods of time where, the funds from operation have been rising. But what you do see here is the dividend has steadily increased during this whole time frame here. And I think that's the real important point is right now this company is yielding over 15%. It's come down to about 14.68% because we've had two really good days here recently on the stock price. But again, if I bring stock prices into the equation, you now get a perspective of whether the stock price is trading at a valuation that makes sense relative to what the fundamentals of the company. So I'm going to continue to keep stock prices off of the chart here just to make a point. When I'm looking at this REIT right now, I do see a little bit of weakness in funds from operations. The company's had some problems with some tenants. That's been widely publicized. It's one of the highest shorted stocks. I think it's still 18 to 20% short interest on the stock, which might be why we're starting to get a rally here for the last couple of days where these guys might be starting to cover. But the point I'm getting at, those are speculations. I want to deal in the facts and the facts only here. And what I see here is that funds from operations have weakened a little bit, but nowhere to the extent that would justify the big drop in stock prices. And when I go ahead and look at AFFO, this is important because I want to illustrate an article here by my friend Brad Thomas, who is a resident expert in REITs on sites like Seeking Alpha and his own website, iREIT, where he talks about FFO and how the AFFO payout ratio, is showing in the 90% range here by looking at regular analysts currently. We're looking at an AFFO payout ratio that's relatively high, but he calculates it at over 130%. And I'll talk about that here in a moment. But again, I look at AFFO and I don't see anything alarming here. I also like to look at EBITDA. I think EBITDA is a very useful metric to look at with REITs as well because, again, it's cash flow oriented. And what's interesting is you do see this collapse in EBITDA in 2013 and 2014, but the problem is I didn't see anything happening in stock price during that time. Okay, the stock price actually just seemed to ignore that. But right now, EBITDA is holding up real well. And then, of course, what's also important, I like to look at revenues. And I'm seeing nothing here that's alarming that would cause or justify this huge drop in stock price. Now, the company just did maintain their dividend on their last earnings report. Everything actually looked pretty good, and we're going to go through the financials here with you in a moment. But I do want to bring your attention to an article that was posted by Brad Thomas, and it was on Seeking Alpha, and it was on May 18th, just a few days ago. And the title of the article is "What's the Probability of a Dividend Cut for Medical Properties Trust?" And this is a very interesting article and very comprehensive. And he talks about price to FFO and the payout ratios of FFO, and he talks about the short interest, but he also talks about the probability of a dividend cut. And he gives it a coin toss, 50-50, or even up to 100%. And he doesn't actually think a dividend cut would be too bad. And he puts it in around a 25% dividend cut. He thinks could make sense for preserving the company's cash flows. But they really don't need it because right now the dividend looks like it's fairly covered. So he goes into comprehensively talks about funds from operations and AFFO and how he calculates the payout ratio differently. Some very good stuff here and very interesting stuff that I think you all would, could maybe, that are worried about Medical Properties Trust, might want to take a look at that article. Point is that right now the stock price is well down. And, I talk about this often in past videos and presentations that I've done with investors. I like to use a little metaphor here, and I'm going to utilize it today. When you're looking at company and when you're looking at stock prices and you're seeing the stock price drop like this, it reminds me of a cute little anecdote that I like to share. Imagine yourself walking into your favorite store, favorite department store, whatever. And as you walk in the store, you notice that the store is just jam-packed with people. And everybody has shopping carts that are just, spilling over with merchandise. Their shopping carts are full. And all of a sudden, and the aisles are jammed, you can't get past people. And all of a sudden, as you're walking into the store, the manager comes on and he says, "Ladies and gentlemen, I want to thank you for being loyal shoppers at our store. And for the next hour, everything on the store, every piece of merchandise we have is going to go on sale for 50% off." And all of a sudden, everybody just abandons their carts and runs out of the store. And then all of a sudden, the manager realizes his mistake, and about halfway, with half the people leaving the store, he stops them and says, "Wait a minute, ladies and gentlemen, stop. I made a mistake. Everything for the next hour in the store is going to increase by 50%. And everybody turns around, comes out of the parking lot, runs back into the store, and starts madly ripping merchandise off the shelf. Well, obviously, nobody shops like that. If the manager gave you 50% off, you would go into a shopping frenzy. And if he raised the prices by 50%, that's when you'd abandon your carts. But nobody acts like that with the stock market. When prices drop, regardless of what fundamentals look like, people abandon their shopping carts, their stock shopping carts. And a lot of people have done that on MPW. Now, the fact that the dividend yield has gotten up over 14%, now it actually got up over 15%, but we've had a couple of days of pretty good performance. I think the stock's up a little bit today, as a matter of fact. Is this the bottom? Who knows? Nobody can predict the top or the bottom of the market. But what I'm looking at here, I don't see anything fundamentally that justifies this massive drop in stock price. So what I'm going to do here, I'm going to turn it over to my son, Colton. I'm going to let him go through the financial statements with you and just talk about some things that we see financially in the company. Colton?
Hey everyone. So we're going to take a look at a few financial statements or a few items on the financial statements, starting with sales. As Chuck said, sales are increasing, and the income statement for this company isn't something that I don't really want to pay attention too much to. It's more of the balance sheet and the cash flow statement that I want to look at. So starting with the balance sheet, one thing that I don't want to necessarily say that is a big worry per se, but just something to keep in mind is the cash that the company has on hand. So historically, this company has not really carried that much cash. If we look back in 2012, back all the way to 2015, it was below 100 million and then raised up to about 200 million. And then stayed there for the next few years. And then in 2018, they had a big cash inflow. 2019, they had a large cash inflow, which brought their cash up to 1.4 billion. And then now it started to drop down to about 200 million. Another part that I want to pay attention to is this total investments section. So, most of their investments are in real estate. They've been growing their real estate portfolio. Obviously, it's a REIT, right? They've been growing their real estate portfolio significantly over the last few years. Brought it up to 16.4 billion in 2021, and it's dropped down to 14.7 billion in 2022. We'll also look at some capital expenditures that this company is spending on and how much they're spending on CapEx. So as we can see, total assets are increasing relatively healthy. We've seen this small drop in 2022, but I don't think it's necessarily something to worry about. Debt, has been increasing over this time frame of low interest rates, which is, I would say, a normal thing that we've been seeing in the markets. And, they're actually starting to reduce their debt now. Liabilities are increasing slightly, right? But we're seeing a larger increase in surplus in assets than we're necessarily seeing in liabilities. So, common equity is equal to total assets minus total liabilities. So in a way, you can see that we've got 8.5 billion in surplus of assets, 8.4 billion in surplus of assets here. So assets are growing, faster than the liabilities of MPW. Now, taking a look at the cash flow statement, capital expenditures increased significantly over the last few years, but have now been decreasing. So this company is starting to spend less money on investing in, or not necessarily investing in certain types of investments, but more, in CapEx and reinvesting in the company itself, right? So they're spending less on CapEx, which, that could be an issue. It may not be. They're definitely reducing their cash outflows. So in terms of investments, they are actually liquidating investments faster than they are purchasing them. We can see that the net up here is a positive cash inflow. Here's the purchase of investments and the sale and maturity of investments. So they are depleting their investment portfolio faster than they are rebuilding it. And, we saw that a little bit in terms of what was happening on their total assets, but they are still increasing their total assets faster than they are depleting them. And then back to what Chuck said about dividends and what Brad's saying about dividends. We may see a dividend cut, and that would be to preserve cash. But I will say it's not necessarily going to preserve a ton of cash. $700 million in dividend payments isn't a small amount, but if they were to drop that by 25%, that'll raise a couple $100 million, but it's not going to, necessarily pay for all their liabilities. Not saying that that should be the case, but it's just something to keep in mind that, yes, it will free up some cash, but I don't think it's going to be a game changer in terms of cash that would be freed up. Last few years, they've been bleeding cash, but, they've been decreased it by $1 billion back in 2020, decreased it by 94 million in 2021, and then decreased it by another 200 million in 2022. So, they are decreasing cash. They still have cash on their financial statements, on their balance sheet. Another thing actually I want to look at is their change in capital stock. So, they've been issuing stock all this time. They issued 1 billion, this isn't shares, but $1 billion of stock, 400 million, and then 2.5 billion back in 2019. We've actually seen a repurchase of stock, so cash outflow. So they're starting to buy some stock back. So they were selling stock at high valuations, and they're starting to repurchase some stock now. So we may see them raise some debt possibly to continue to buy stock back if that's the case, should see a increase in price, or could see an increase in price if they continue to buy stock back. But yeah, that's kind of what we're seeing on the financial statements, the movement of cash, how things are going. So in summary, assets are increasing faster than liabilities. Because of that, maybe we'll see an increase in debt and a repurchase of stock. And that's definitely something that could be done. And even, like Brad said, a cut in dividends, and all of that could be going into repurchasing stock or, investing in new properties and whatnot. So yeah, that's about what I see on the financial statements. I'll kick it back to Chuck to finish this video.
All right, thanks, Colton. I do want to reiterate and cover a couple of things that Colton talked about that I think are very, very important. When you look at the company from a standpoint of funds from operations, then, it's critical to understand that when the company was reasonably valued or fully valued, they were selling stock. Now that the stock price has become cheap, they're starting to buy stock back. I think that's a real good sign. The company's, trying to do everything they can to enhance shareholder value. Right now, if this stock price went back to reasonable valuations or normal valuations, a normal priced FFO of around 12, or even a theoretical fair value priced FFO of 15, this little bit of weakness we're seeing here does not justify this massive drop in stock price. So we could be looking at a really great long-term opportunity. Even if there is a dividend cut and the company preserves cash, that doesn't necessarily mean that, it's the end of the world. If you're an income investor, that might hurt a little bit, but you could be rewarded by capital appreciation. That could be the catalyst to basically where you see shorts starting to cover their shorts. And, Colt also talked a lot about debt. I do want to show you something that I think is real important. If you go into the corporate websites of real estate investment trusts and you go into investor relations and then look for their financial statements, especially their quarterly reports or their annual reports, you can find a lot of information about the companies. So what you want to look for are quarterly supplemental reports. And let me blow this up a little bit so y'all can see it. One of the things I like about this report, you can get an awful lot of information out here. Instead of being scared about stock prices, you can go in here and learn a lot about the company, how many properties they have, how many beds they have, learn a little bit about the management team. You can also get into here and look at some of the financial information like the Colt was going over, the FFO, the diluted share data. But if you keep scrolling down here, you're also going to come into their debt covenants, where you can see how much debt they have, what the maturities of their debt is. Of course, you can learn a lot about their portfolios. So you've got a wealth of information. Knowledge is power. And just looking at stock prices and worrying about stock prices, you're shopping like the crazy shoppers who ran out the store when they lowered the prices. Just because the price dropped doesn't mean anything. I did an article years ago titled something loosely like prices are two-faced, and one of them is a pathological liar. Stock prices often lie. So, there are ways for you to get information right through the Fast Graph research tool. I'd encourage you to do that. There's all kind of information on their portfolio here. These supplemental reports can really give you a whole, a bunch of information on the stock, including their debt covenants and so on. So anyway, this has been Chuck Carnevale saying thank you for watching the video. I hope you enjoyed it. I want to thank my son Colton for giving us some insights into the financial statements. I think MPW is an extremely low valued REIT right now that has fundamentals that support a much higher stock valuation. Whether they cut their dividend or not is something we're going to have to see. But, one thing I think that Brad Thomas mentioned in his article, the directors and the board of directors determine the dividend policy are going to protect the balance sheet more than they are the dividends. So, that may happen and may not happen, but I think the company could cut the dividend and still cut it in half and still have a very, very high yield investment here. In longer term, I believe buying the stock at these values could lead to extraordinary, price, and capital appreciation opportunities here. Again, if this gets back to value, this thing could average over 40% a year. So has, our opinion changed on MPW? I want to make this point. I want to close with this point. A long-term investor looks to own a stock for 3 to 5 years or longer. They look to own it over business cycles. Companies only report, financial information, earnings and cash flows and FFOs and dividends once a quarter. Okay, and you've got to give the company time to either create value or build value for you. A couple of months, like we're talking about here with MPW, is not long enough to make a judgment. And as price is down, as long as you haven't sold that stock, you've got an unrealized gain or loss. You can fix it by buying more if you believe the fundamentals are strong. But once you sell the stock, then you have established a loss. Right now, I don't think the party's over yet. I don't think, as they say in the opera, that the fat lady has sung yet. I think there's still a lot to be looked at. I think we got to give the stock a couple of more quarters to start getting some more information to where we can start making some better judgments. But I intend on owning this stock for years to come. I think it's an extremely undervalued REIT, and it's an opportunity you might only see once or twice in a lifetime. But you have to make that judgment for yourself. Thanks for watching. If you like this video, give me a like, ring the bell, subscribe to the channel, and obviously, if you're not doing it already, take a look at subscribing to FastGraphs, because only here can you get this idea of looking at the stock price in relationship to the fundamentals instead of just looking at the stock price in relation to itself, where you have no other information on here other than the stock price is going up or down, and you cannot make a judgment of whether or not it's been justified or not. Anyway, thanks for watching. Talk to you again real soon.